Hi, everybody. This is Josh Jelinski, the financial quarterback, with Jeff Snider of Alhambra Investments, head of global research. And according to his bio, he's not an economist. So what does that mean, Jeff?
I'm not formally trained. I don't have a background in economics, at least formal economics. I'd like to think I have a good background and a good grasp of small e economics, which is, the macro stuff and really the research, doing research behind it, especially in the topic of the monetary system, which economics, capital E economics and formal economists have done a very poor job of describing, measuring, investigating, being curious at all about what actually really happens in the global monetary system. Everybody's just basically been told for a long time to just leave it up to the Federal Reserve and forget about the details.
So you describe yourself as developing a working model of the global monetary system. What does that mean?
Well, it's the monetary system isn't what we've been taught. And everybody thinks that the monetary system is just the U.S. dollar, that the U.S. dollar is therefore the global reserve currency. When they give it a second thought, that's usually what everybody believes, and that we went off the gold standard in August of 1971, and that was somehow an important date. But if you spend any amount of time, do any little bit of research in the monetary, what actually happens in the monetary system, what you find is that there's this global reserve currency system that isn't necessarily, it's denominated in the U.S. dollar, but it's called the euro dollar. There's a whole ecosystem out there of, offshore banks doing business. It's denominated in the U.S. dollar, but it isn't any kind of official setting. And more than that, because it's a bank-centered global system offshore outside the United States, trading in U.S. dollars, the Federal Reserve really doesn't have a spot in it, nor are they actually statutorily allowed to do much influence over what happens in this global monetary system, which is kind of the opposite of what we've been taught and told from the very beginning. It starts in Economics 101, where you're taught, hey, the Federal Reserve is basically the most powerful institution on the planet. It does what it wants. It prints money if it has to, when that's not the case at all. It's this offshore Eurodollar system where everything comes from.
Well, this is fun. This is going to be a great interview already. So Lacey Hunt says it's the lender of last resort. Would you have any issue with that statement?
Yeah, I think the Fed would too. The Fed actually calls itself nowadays, because it doesn't do money printing. It isn't in the money business. The Fed says its monetary policies are not lender of last resort because they can't be. Instead, they call themselves the market of last resort. So if you can't do money, you can't do currency elasticity, because this is an offshore Eurodollar system that's outside of your jurisdiction, as well as completely a blind spot to domestic monetary policy. You're kind of stuck with, when things go wrong, all you can do is maybe try to bid up some asset prices and hope the crisis goes away, because that's not what a lender of last resort is, and that's certainly not what Walter Bagehot had in mind when he first described the modern central bank in the 19th century, which is an institution, a public institution that would lend freely at high rates on good collateral. But that's not what the Fed does. The Fed does QE, which is entirely different. The Fed does these market support operations, as it did last year. Not a central bank at all, at least not in the historical sense of it. And the reason is because the monetary system operates outside of the Federal Reserve's hands and intellectual framework, if you will.
Why is that? A lot of people, when you would say euro dollar, their eyes might glaze over. So explain what the euro dollar is. And so you're basically saying, well, then I'll explain what the euro dollar is, and then I'll ask you about the Fed.
Yeah, what we're basically saying is the Fed gave up on the money business a very long time ago because of this Eurodollar. Eurodollar, nobody really knows where it came from. It showed up around the late 1950s for several different reasons we don't need to get into here. But essentially, these were dollars operating an exclusive dollar market that operated outside of the United States, all around the world, and it took over the roles, even though Bretton Woods was still in force, it took over the roles of the global reserve currency system. And as it did, because it was a bank-centered system, it evolved constantly so that the banks that were operating in it outside the United States as well as inside the United States, these banks basically innovated in different ways and experimented in different ways so that the definition and the workings of the monetary system itself completely changed. So that by the late 1960s and early 1970s, the Federal Reserve threw up its hands and said, we can't even define what counts as money anymore. So by the end of the 1970s, they basically gave up altogether and said, we can't do money in the way that central banks used to do money, so we're going to do something else. And that something else happens to be expectations management policy, which we know of in the form of, Alan Greenspan's interest rate targeting mechanism, where the Fed sort of says, we're going to target a certain rate of the federal funds rate, and that's going to account for what we hope is some kind of monetary input into the real economy, leading to predictable economic results. And for a while, that seemed to work during the Great Moderation. But behind all of that was this monster Eurodollar looking outside of the U.S., outside of our conception. We call it shadow money for that very reason, because the Fed doesn't do money anymore, and it hasn't. It goes back a very long time where the Fed basically said, we can't keep up to the monetary evolution that banks are undertaking at the time, so we're not even going to bother. We're just going to let the banking system take care of money. And if we can try to influence their behavior by moving the federal funds rate around here and there, we'll be perfectly happy with letting the banks do the details. And that seemed to work at least until August of 2007.
So what is the euro dollar? Some people may have never even heard about it, or they don't even know what it is. What is it?
No, I would wager that the vast majority of the public has never heard the term Eurodollar, or at least not put it together. I mean, if you know anything about LIBOR, the London Interbank Offered Rate, that is a Eurodollar rate. That is a rate that applies to dollars that are on offer outside the United States. And that's really what the term euro means when you pair it with dollar. It has nothing to do with the European common currency, which didn't come about until the 90s. Again, this started in the 1950s. Euro simply means offshore. It's an offshore currency market. And offshore means, again, dollars that are traded outside the United States. But where the Eurodollar system took things a step further, because, again, it was a bank-centered system, this is not actual currency. It's not like there's physical Federal Reserve notes, dollar bills that are being flown around in pallets outside the U.S. That's not the case at all. It was essentially the first virtual currency system, a form of ledger money, where banks simply traded computerized numbers about assets and liabilities. And so long as those numbers agree at the end of every day, it's actually an efficient way of doing currency. Because you don't have to hire guards, you don't have to hire accountants, you don't have to you move around physical currency. All you're doing is moving around numbers on computer screens, which are called dollars, but they operate very differently. So whenever you see the term euro paired with a currency, it just means offshore. So the euro currency market, there's euro dollars, there's euro yen, there's even euro euros. So it means outside of the jurisdiction of whatever country is involved in it. And again, it's a bank-centered system, which means banks are trading virtual ledger currencies.
So it was Bitcoin. Was it Bitcoin before it was Bitcoin?
Absolutely. In fact, there's a name for it. There's a technical name for it. It's called money of account. And historically speaking, this kind of ledger money has been called ghost money even. So the Eurodollar shares a lot of similarities to the way Bitcoin theoretically works, as well as some of these other various forms of money of account over time that developed as far back as the 14th and 15th century. So the Eurodollar actually is virtual currency that traded electronically without the need of reserves. There's no need for physical reserves, because that's not what banks want. In fact, reserves or physical currency actually slows everything down. It's much better and more efficient to do this electronically, to do this as a ledger format.
Now, we had Lawrence J. Kotlikoff on a few weeks ago, and he talked about it. He was talking with someone from the Swiss bank, some high up figure, maybe very high up. And they were saying they were looking forward to CBDCs because then they would go around the dollar, and just if they wanted to trade with the U.S. or they wanted to trade with Canada, they would kind of do an end around. Is that an end around of the euro dollar or end around of the U.S. dollar?
Well, I'm not familiar with the exact statement, but it sounds like, CBDCs are something else entirely. They're not really a native cryptocurrency anyway. And the real purpose isn't really about, elasticity in the global system. It's more about surveillance techniques. But even if the CBDC were ever developed where it would actually be a legitimate currency, which I have my doubts, but if that were ever the case, it still wouldn't obviate the need of an intermediary currency, because that's what a global reserve currency is for. You need a reserve currency in the middle between these various different systems so they can translate and talk to each other. So I don't see how a CBDC would be able to work around the Eurodollar, because it doesn't. It's simply just another form of their own local currency, which, if it's not acceptable globally, then what's the point? You're really just doing the same thing in a digital format, which is really what CBDCs are. They're not actually a step ahead. They're just trying to bring what central banks already do and make it appear like it's stepped up into the digital age. And that's really all it is. It's all for appearances.
This is Josh Jelinski, the financial quarterback. And folks, if you want the 45-minute ultimate financial game plan, call us now, 888-988-JOSH, 888-988-5674. When we return, we'll be asking Jeff about economic growth. Is it peaking or contracting? And we'll ask him about Bitcoin and the shadowy system. You know, I'm sure you'll want to know more about this whole kind of Eurodollar thing. When we return, this is Josh Jelinski, the financial quarterback, and call us at 888-988-JOSH, 888-988-JOSH. I'd love to meet with you over a free 45-minute Zoom webinar, 888-988-JOSH. And we're back with Jeff Snider of AlhambraPartners.com, who I didn't know you were this famous, Jeff. Apparently you've struck a nerve with some of my buddies on Clubhouse. So
I had no idea either. And again, as I said, I don't know. I've never used Clubhouse, so that's news to me. And I think that that's a good thing. But I think what's really interesting.
Clubhouse
or what's really,
was the stupid app that I think Elon Musk went on like 7 months ago and was having these chats, and that's sort of how it became this big thing. They turned a $4 billion offer from Twitter down, and then Twitter Spaces kind of ripped off Clubhouse. So it's kind of like an online chat room. It's almost like a virtual, remember when you were younger, the AOL chat rooms? It's like an AOL chat room, but it's audio only. So you can talk to all kinds of crazy people. So you would do well there.
Yeah. Well, I'm glad that people are taking an interest because, for the first time in memory, as I said before, we've been told since the very beginning that you don't need to worry about this money stuff. The Federal Reserve's got it all covered. I think people are starting to get the sense that they don't, and they kind of want to know why we keep having all of these monetary issues, these economic issues that derive from the monetary issues. And maybe we do need to start asking questions about what's going on and not just trust the Fed or don't fight the Fed with everything and everything that's important.
So we'll talk about Fed policy, but first, does your research point to the economy growing or contracting right now?
Oh, I think it's still growing, but the real question is whether or not it's actually in recovery or if we're still kind of stuck with the aftermath of the 2020 recession. I mean, look, we had massive amounts of especially fiscal government intervention earlier this year, which had an enormous short-run impact. But that was always going to be temporary. No matter what the economists say about, greater than one multipliers and how these things are supposed to be extra special toward creating recovery mechanics, they never do. So we always expected that after the fiscal intervention earlier the year, we'd see things start to slow down. And the question was always going to be, when that slowdown showed up, what then? Are we still in a kind of growth kind of period, or are we still kind of more stuck and mired into the sort of lack of growth that we had become accustomed to before 2020 ever came along? So where we are right now, at least in our estimation, is that, we're seeing everything slow down globally, and not from a very high elevation, especially around the rest of the world. So it's really a question, okay, now we have the slowdown, where are we slowing down to?
Well, what are we slowing down to? Inflation, do you think it's transitory, or do you think it's really here and we're going to head towards sort of a stagflation style economy?
Well, inflation is a very touchy issue, and it's an emotional issue for obvious reasons. I mean, look, when you go to the grocery store and you pay a lot more for groceries, that's something you notice. That's something you feel. And especially if the economy is not really great, it's going to be a painful period. But, consumer prices did rise very quickly earlier this year, but it wasn't inflation. Because inflation, the textbook definition, the real definition of inflation is Inflation, as Milton Friedman said, is always and everywhere a monetary phenomenon. When you actually look at the monetary system, you don't pay any attention to the Federal Reserve's balance sheet or bank reserves because that's not money, as we said before. We have to look at what's going on in the Eurodollar system, and there is no money creation there. The banks themselves are telling you what they're doing, and it's not risky. They're not lending. They're not creating money and credit in the way that would be inflationary. In fact, they're doing the exact opposite of those things. So that means that there isn't the monetary background, there isn't the monetary environment that would be conducive to inflation. That is consumer prices advancing in a broad fashion in a sustained way, not just for a couple months in 2021, but continuously time and time again going forward. And so there isn't the monetary component to that inflationary potential, which means there was something else causing consumer prices to rise earlier this year. And it's really not a mystery. You've got supply bottlenecks, you've got supply problems around the world. Plus, you also had that massive fiscal intervention that kind of created the supply and demand imbalance, which again boosted prices too. So it was always going to be transitory because, again, there wasn't the money behind it to keep it going. And that's what we've already seen. Various CPI indices, producer price indices, today import prices and export prices, they're starting to show, and especially the further away you get from the goods economy, they're already showing the other side of transitory. They're slowing down on a monthly basis.
So do you think we're headed towards deflation?
Well, I would call it disinflation. It's deflation in certain parts of the world, but the U.S. usually gets into a disinflationary growth pattern where you don't see inflation. You don't see rapid inflation. You certainly don't see accelerated, sustained inflation. Instead, you just have this kind of moribund, lackluster growth period where the economy doesn't really do all that well. In fact, since we live in a nonlinear world, we're really actually falling further and further behind. But yet, it's not like it's not like the economy's horrible. It's not like 2008 and 2009 all over again. It just seems like the economy is unable to grow because it really is unable to grow. So that means, without the inflation part of it, it's not really stagflation. It's really disinflation. It's really lack of growth because we don't have an answer to, even 14 years later, this Eurodollar system that has continuously malfunctioned and malformed.
Are there proposals to improve the Eurodollar situation or not really?
God, no. It's not even on anybody's agenda. That's the problem here because, as I said before at the outset, the monetary scholarship that needs to take place, we're 50 years behind. Again, central banks and economics gave up on the monetary part of the global economy because they couldn't keep up with it. And so they just kind of left it, set it aside, and they've convinced themselves and the world that this manipulation, this expectations management way of doing monetary policy, which is non-money monetary policy, is effective. And that's why they do one QE after another, after another, after another, because they don't know what else to do. Because there's no way Jay Powell is going to stand in front of the world and say, you know what, we're not really a central bank. We don't do money. We just got to keep people thinking that we do money because that's the only way we think it can end up, that it'll end up having any kind of success. But what that means is that nobody's actually looking at the monetary system itself and saying, what do we need to do about it? In some sense, that's what digital currencies and cryptos are doing, because the Eurodollar malfunction has opened the door for another avenue for elasticity, another currency system potential. But, officially, the central bank is never going to talk about the Eurodollar. They start to get into some of the wholesale elements. They're starting to look at repo, for example, which is a key part of the global Eurodollar system. But only recently have they really taken a much closer look, and it's even not that close, but they've started to look much closer about collateral shortages, collateral scarcity, and all the deeper fundamental plumbing elements to the Eurodollar system. So even as we're here in 2021, 13 years after all this stuff created a global financial crisis, back then it wasn't subprime mortgages, it was a global dollar shortage. Again, the official sector is still in denial about all these things and only working a little bit around the edges. So we're not even close to, central bankers and economists admitting that there's this monetary problem, let alone doing something about it.
So what do you do? I mean, what do we do? I mean, it's sort of, I guess explains the rise of Bitcoin and all of these cryptocurrencies. Although it seems, as I listen to you, the rise of Bitcoin is really people saying, we want a new system, one that we can have some trust in, some belief in, I mean, what's your take on Bitcoin with all this?
Absolutely. I think that's exactly right. And the irony here is that what's driving Bitcoin prices and a lot of other digital currencies is the mistaken belief that the Fed has printed too much money, and therefore they're going to destroy the dollar. So a lot of hardcore Bitcoin maximalists are sitting there waiting for the day the dollar dies and then Bitcoin takes over. And I think they're misunderstanding some of the mechanics here, especially what the Federal Reserve actually does, which is not print money, which is why the dollar only goes up in exchange value rather than down, as everybody keeps saying. It's already one signal that something's missing in your worldview. If you keep saying the Fed's printing money, the Fed's doing all this, it's doing way too much, it's too powerful, yet why isn't the dollar going down? And the other part of that, too, is interest rates. Why are interest rates only going lower? We're taught that that's because of the Federal Reserve, but if you go to the Federal Reserve's website or any central bank's website and look up their scholarship about quantitative easing, what they'll admit is they don't control bond yields, they don't control interest rates much at all, and that low interest rates are actually a sign of tight money, not loose money. Like the 1930s in the U.S., interest rates were low and they stayed low. In the 1970s, when inflation was actually high, interest rates went up and stayed high. So we're already looking at the monetary situation the wrong way because the Federal Reserve and economics has done such a poor job educating the public. And because of that, as you just said, Josh, I mean, that's exactly right. That has opened the door for competing currencies that are just looking for answers. They're just ways of saying, we're sick and tired of all this stuff from the Fed. It doesn't appear to ever be working, and we don't even really know what goes on. So let's start again with a transparent, or at least what we think is a very good, blockchain's good for this, is a transparent way of maybe doing money differently. And let's see if that works. And ironically, I think it's, most people that are piling into Bitcoin are doing so with the mistaken impression that the dollar's going to crash, when it's in reality, it's the other way around. The dollar gets stronger because of the global dollar shortage that the Federal Reserve can't fix. But nobody can connect these dots because, again, going back to our education and what you see in the financial media time and time again is, pay no attention to money, just let Jay Powell take care of everything.
Well, wonderful. Maybe not wonderful, but interesting for sure. So we'll talk about...
there is some optimism there, right? Because what we're talking about is a potential solution down the road. But
I want to talk about the optimistic note when we return. This is Josh Jelinski, the financial quarterback. And if you want the 45-minute ultimate financial game plan, that's 45 minutes with us over phone, Zoom, webinar. You actually can get a free ticket to my next webinar as well. That's more of a group webinar. But if you have a one-on-one, you want to meet with us in person, call us 888-988-JOSH, 888-988-5674. And when we return, I'll ask Jeff about, what are opportunities in this seemingly pessimistic worldview when we return. This is Josh Jelinski, the financial quarterback. And we're back. This is Josh Jelinski, the financial quarterback, with Jeff Snider. So where's the optimism here, Jeff?
The optimism is that digital currencies, real digital currencies, especially blockchain technology, have the capacity, or at least, the future capacity or future possibility of solving a lot of our monetary problems, which begin and end with the fact that, the Eurodollar system, this offshore bank-centered system, nobody really knows anything about it, even those of us like myself who, I spent the last 20 some odd years trying to figure out all what's going on. And it's a completely opaque. It's not transparent. Banks are, they're using their privilege of maintaining this ledger money of account system. Therefore, it privileges what banks do rather than the real economy, which causes all sorts of feedback problems. And in a lot of, possible ideal situations, digital and cryptocurrencies can solve a lot of these drawbacks. And maybe if done correctly, it's not going to be easy. And of course, central banks and governments are going to fight tooth and nail against any sort of private monetary solution. But there is potential there. If everything goes maybe just right, and maybe, there's a little more leeway than that, there is a lot of hope in digital currencies. It's not because the dollar is going to be destroyed by money printing, because that's not happening. It's because there's a lack of dollar elasticity in the global economy, and we need a competing currency system, a realistic currency system that could potentially take some of the reserve currency roles that are not being filled by the current monetary.
But will these shadowy actors allow it to happen? Or will they, in fact, buy, like if I were them, right? If I would just start buying up all the Bitcoin so that they control that market too.
But that would just lead to the Bitcoin 2.0. I think it's really an arms race. But you're right, Josh. I mean, like I said, it's not just the central bankers and politicians that are going to fight tooth and nail against this sort of private, decentralized monetary system. The banking system as well has enjoyed these privileges, even though the last 14 years for banks have been an incredibly awful time. It's better than the alternative, which is, decentralized finance. If it goes correctly, we don't even need banks anymore. You really don't need that kind of intermediation, nor do you need that sort of information asymmetry, because in a truly decentralized blockchain format, everything's open and available to everybody else. You don't need banks, which are nothing more than glorified accountants nowadays anyway. So a blockchain could take the role of a lot of these banks and what they do. So, yeah, I mean, the more far-sighted of the banking institutions that currently enjoy their Eurodollar privileges are going to do everything they possibly can to hold on to what they have, even if what they have is meager and it doesn't really work very well for them.
We hear that, I guess, with Jamie Dimon always being very negative on Bitcoin. But here's another take. I think 99% of these cryptocurrencies are scams, not Bitcoin.
A lot of them are.
And
absolutely.
I think the DOJ is going to go after all these cryptocurrency scams like Shiba Inu or whoever, because what I don't get is you're some billionaire like Vitaly Buterin, one guy, and then you have a Tesla tweet, an Elon Musk tweet. I mean, it's so, some of this is like, they're pumping and dumping these various cryptocurrencies. Once the DOJ gets in there, a lot of the more centralized, because most cryptocurrencies, it's funny, they're supposed to be decentralized. There is usually some guy who gets super rich, who was at the center, who created the code, which is sort of against it. And that's sort of the genius of Bitcoin. Nobody knows, who Satoshi was and all these other things, but I think
I think you got to separate what's going on in some of these more risky plays as well from what the actual technology and the development of the technology is happening. Again, as I said, I think a lot of people are trading crypto for the wrong idea. They think the dollar is going to crash, inflation is going to go through the roof and stay that way forever, when some of these technologies like Ethereum, for example, and Bitcoin, as you referenced, they're actually legitimate technologies. You have to sort the wheat from the chaff, which is difficult. And anytime you face we get into a period where there's disruptive technologies, think the .com era, for example, there's always that kind of potential for fraud and scams and doing things that, just make no sense, which is going to always be, that's always going to come along anytime that we're in these periods where, again, this is really, really positive and potentially useful technology. But it's tough to tell which one is legitimate, which one isn't, if you don't do your homework, if you don't really look at them. I mean, you look at a lot of these stable coins, for example, they're nothing more than glorified money market funds. And you wonder, what the hell is the point? And I think you just hit the nail on the head, Josh, when the point is, well, the person who came up with a stable coin wants to get rich for themselves, and that's what they're really selling. They're selling you an idea, and you really have to look behind the idea to see whether or not there's anything significant, substantial in the technology. And there is in some parts of the space, but you're absolutely right. There is a minefield out there that you need to navigate first. You got to be very careful.
Definitely. So you made me think about, well, where are the opportunities? If what you're saying is true, Eurodollar, dried up liquidity, disinflation. I asked Lacey Hunt this. You two are in the same camp on disinflation and kind of how things are disinflationary, then you really shouldn't buy a house right now.
No, you should wait for prices to come down.
Yeah, and what about stocks? Are you pro stocks, against stocks? What are your opinions on opportunities?
I'm stock agnostic.
Depends on the stock.
Look, no, I mean, stocks are, everybody. That's where everybody looks to, because again, that's what we're conditioned to look to. And you have to realize that stock prices don't trade on any sort of fundamentals, because they don't, and they haven't for a very long time. Which means, that doesn't mean you can't invest in stocks. It just means you have to be careful, like digital currencies. You got to be careful about what you do in stocks, because there really isn't that kind of fundamental anchor. Certainly not in this age of passive investing where stocks just, everybody piles into stocks because everybody piles into stocks. And that just means that, stock prices aren't representative of something tangible. They're like John Maynard Keynes had long ago said, it's a beauty contest. And so, again, you can own stocks, you can buy stocks, you can trade stocks, realizing what they actually are. They have nothing to do with the macroeconomic situation whatsoever, certainly not in the short run. But that doesn't mean that, that you completely avoid them because, stocks can go up for a very long period of time and you can miss out on some gains if you just completely eschew them exclusively.
So where do you see any opportunities for people's money right now? I'll ask it that way.
That's a good question. It's about understanding what becomes more valuable in a disinflationary environment. I think you already mentioned one type of situation, which is real estate's not necessarily the best place to be. And I will also add with the real estate segment right now, I mean, again, the artificiality of the last, 15 months or so where, some parts of the country, real estate has just gone crazy, especially where I am in South Florida, which means that, it doesn't necessarily continue, and there's always opportunities when things change. And if things really do change, you can certainly position yourself to make money in other ways.
So keep your powder dry. We'll be back with more opportunities with Jeff Snider, head of global research at Alhambra Investments. He is not an economist, but he plays one on TV. No, he's a worker of models of the global monetary system. We got to I guess he's the head of global research. Fascinating interview with Jeff. And folks, if you like the interview, make sure you subscribe to our YouTube channel. Share the podcast. We're on iHeart Podcasts, also Spotify and WOR every Saturday and Sunday at 9. So, folks, call us right now, 888-988-JOSH, 888-988-5674 for the 45-minute ultimate financial game plan. And if you call us right now, you can score your top 5 holdings from a perspective of risk, taxes, and fees. So call me now, 888-988-JOSH, 888-988-5674. And we're back. So we're going to talk about the shadowy roles. I mean, someone talks about the shadowy system that dwarfs the Fed. It sounds a little conspiracy theory-ish. So we are going to get to that, get to some of the, I guess, other conspiracy theories with that, since you're talking about the euro dollar. But I want to go back to the Fed not doing anything. Then I want to get to opportunities with one's money. So Lacey Hunt shares a very similar perspective, different. You come at it from different angles, which is kind of cool. He said to me, don't buy a beach house. And I was going to buy this house on this inflationary zeal. And the house is now up $800,000 from when I had him on in April. And I'm sure a lot of people listen to guys like you and they say, this guy makes sense. Lacey's one of those people. And then they keep their powder dry and they hold cash or they hold treasuries or boring stuff. And then the market just keeps going up, or the real estate market keeps going up. So the reason why I asked for what to do with one's cash or investments, we're not giving investment advice, but maybe asset classes that would do well in a deflationary world. What that would really mean if we have disinflation, I kind of know what I would recommend, but you really wouldn't be a buyer of real estate. But what if the fundamentals of real estate, meaning millennials? So I bought my first house at 22. You probably bought it in your 20s as well, or no?
Yeah, somewhere around there.
That was sort of our generation. I think we're maybe similar. Maybe you're slightly older than me. But then there was a shift with the millennials, which are a couple of years after me. They waited till like this year to buy their first home. I'll have millennial clients. They're 38, they're 37. They're making that big purchase now. That's a big generational shift with demographics. I also think that's at play with the boom of real estate, particularly in Florida, where you are. You have boomers retiring in New Jersey, New York, going to Florida to avoid taxes. Other people moving to Florida, Texas, other tax-free havens to avoid taxes. So you have this kind of a super cycle right now. Tax minimization, COVID. People like, I want to have a red state governor, not a blue state, because I don't want to, live under oppression, or what they perceive. I don't want to get political here, but so you have COVID. So we have people from where I'm living in New Jersey. New Jersey's real estate market was dead. New York City revived it because people said, I'd rather have an acre or half an acre. And if we're under lockdown, I want to read my book outside in a lawn chair. You know what I mean? So that was a big thing. New Jersey's all of a sudden a hot place to move to. Was not before. People in New Jersey moving down to Florida first. So you got taxes, boomers, millennials, whatever other, there's a bunch of other reasons. COVID, those 4 reasons are massive though. Have really nothing, and then you have inflation, I guess, and supply chain issues. But some people would say, well, those millennials are just starting to buy homes, and the builders aren't building as many as they used to, except maybe in Florida and Texas, so that there's a limited supply. So the real estate market's going to stay strong for a while. I would say we got maybe 12 months left of this, and then it's going to start going down because of what I've studied with this inflation. What say you on housing? And then we'll talk equities.
Yeah, like I said, I don't agree with there's always secular trends in real estate, and there's definitely a migration typically from the northern to southern, not just for weather but for economics, as you said. New Jersey versus West Palm Beach, where I'm in West Palm Beach. I mean, you can sell a house today for cash sight unseen to a New Yorker because there's secular trends involved with that. But I don't agree with the big one that you cited, which is millennials are suddenly starting to buy houses. Why haven't millennials been big home buyers when they should have been over the last 14 years? And the reason is because of this disinflationary economic environment.
They were living with their parents.
Haven't been able to afford houses. They haven't been able to move out of their parents' basement. And so if that lack of economic, this is the participation problem in the labor market. If the economy is unable to grow, and it actually may even be worse off because of the COVID recession, which is something nobody seems to be thinking about, then millennials might have gotten a small window where they got a little bit of government assistance to buy houses last year and this year. But then we go back into the same economy or worse as we've been in. I'm not convinced that there's a secular trend involved with millennials starting to buy houses either, or the generation that comes behind them, what is that, Generation Z? I don't think that the economy has turned up nearly enough that would allow that kind of a trend in real estate to happen. I think it's an illusion, along with a lot of other illusions that earlier this year appeared to be a recovery, appeared to be inflationary, but it really was just a temporary short-run impacts of federal government intervention. Again, the Federal Reserve doesn't matter whatsoever. That in a disinflationary, lack of growth environment, you're going to see next year look a hell of a lot more like 2019 than it did in 2020 and 2021.
But but if you look at Palm Beach, right, I don't see the Palm Beach market slowing. I have friends in Palm Beach, clients in Palm Beach, West Palm. I mean, I think that's a sort of a different angle, like Manhattan is moving there, so they could sell their real estate in Manhattan and kind of it's almost a lateral move, or they get more value in West Palm. So is that kind of a one-off? But generally,
yeah, there's, like I said, there's always secular trends like that are, Florida has been a beneficiary of a secular trend that's non-economic in nature because, I mean, for the longest time, as you just said, Josh, boomers would move to Florida regardless of the economic circumstances. They just like moving to Florida for different reasons: taxes, sunshine, whatever it happens to be, an easier lifestyle, less traffic, all that stuff. I mean, that's going to continue forever. And Florida is probably more insulated than many other states as far as the housing market goes, but it doesn't mean that the entire national housing market is going to continue to do well, because of economic reasons that I think are stacked up against that happening.
So Palm Beach is different. A nasty ranch that you would never want to live in. You put it in Palm Beach, it's going for $7 million. By the way, I saw that trend a couple of years ago. It was, alas, it's a funny story. I'll tell you a story. I put an offer in to buy a drug lord's house. It was confiscated in West Palm. Do you remember?
Was it advertised that way?
Yes, it was owned by the federal government. It was part of like the asset forfeiture. Guy was some Colombian drug lord or something. The house, the offer I put in lost. The people who won the offer paid $11 million. That house today would be like easily $20 million. And I saw it, but I didn't make the offer. I called my friend who lived in Palm Beach. I said, is it worth X? He said, no, it's worth Y. I put in Y. Should have put in X. Could have doubled my money in 3 years. Financial tip of the day. Do not listen to your friends, even if they have a lot of money and they live in Palm Beach, because they could be wrong.
No, they just want to buy the house instead of you.
No, by the way, it's funny. He also put an offer in for the house, but it was lower than mine. So he wasn't, it's pretty crazy what happened there.
It wasn't like The Price is Right where he bid $1 over yours.
But then I looked over right at the ranches and I was like, I'm not going to buy a ranch for $1.9 million. They were 1.9 like 3 years ago. That same house, $7 million. And I just saw it as clear as day. Like, New York's going to come and it's going to be like a Manhattan apartment, which is, I don't know if that's not an unstoppable trend, but it might take a few years for that to burn off. Although,
there's also supply issues involved because there's no beachfront left anywhere. There's only a certain amount of beachfront homes or near water homes. So there's that lack of supply is always going to affect prices when demand goes up anyway. And they're not really building a lot of homes in South Florida like they used to. Certainly not like they used to, 15 years ago. So, there are supply issues there as well.
Interesting. So this is fantastic. We are with Jeff Snider, fan favorite of our YouTube channel. Hit the subscribe button and call us 888-988-JOSH. If you would like to score your top 5 investments from a standpoint of risk, fees, and taxes, call us for the free 45-minute taxes, fees, and risk review. Call us right now, 888-988-JOSH, and you get a free book when you schedule and keep your no obligation review. You can find more about Jeff on realclearmarkets.com, authors Jeffrey Snider, or go to alhambrapartners.com, although you look different than that picture. So we'll get an answer to that when we return. This is Josh Jelinski, the financial quarterback. Don't touch that dial. And we're back. So why do you look so different than that picture?
Why do I look? I think it's, middle age.
No. I don't think you have the beard there, do you?
No, you start losing hair up on top of your head and you start to grow it other places. So, I think it's sort of a one way that the middle-aged people like myself try to deal with getting older.
And it's interesting. I have a buddy of mine. Yeah, he did the man bun before it was cool. And he's like 66. And actually, he doesn't, so he kind of had the Lorenzo Lamas look. And then,
if you've got it left, show it off.
Or the Fabio, and the thickness here covers the Friar Tuck spot behind. Hope he's not listening.
You got to do the comb over.
Yeah. Well, you know what? You get to a phase though where you just do a crew cut or something. That's what my father did.
Probably in my future, so the pictures are going to change again.
I will tell you, my father looked better with the crew cut. I have a picture of him. We'll show our listeners one of these days, or viewers on YouTube. He looked so cool when he just started to bick it, and when crew cut, he was doing the comb over for a number of years. So where are we with opportunities? So real estate, maybe not the best opportunity. What do you like for money right now? I guess it's treasuries, cash, maybe Bitcoin.
Well, you don't necessarily have to sit in cash on the sidelines. Again, we haven't been in cash, for the last year because, in a reflationary environment, which is different from an inflationary environment, there's certain places you can go to. Just as long as you're aware of what kind of a situation or what kind of box that you think that the world is in or the financial world is in, there are various ways to do things. I mean, you could have bought stocks, you could have bought inflationary commodities, from the bottom, especially in 2020. Even though, long run we're in a disinflationary circumstance, there are definitely these shorter term, intermediate term periods where you can do very well riding these short term trends, so long as you realize that's exactly what you're doing. So there's always opportunity. I think it needs to start with what we try to do is properly classify, first of all, what long-run climate are we in, and whether that makes sense in terms of does it deviate from the short run or not. And if it does, it doesn't mean you just sit on the sidelines and do nothing. It just means you tailor your investments, or at least you try to tailor your investments to what you think is more accurately, more realistically taking place.
So what do you like now?
What do I like now? I don't know. That depends. It really depends on the individual investor. And again, you get into risk tolerances and things like that because, there's the sky is wide open in terms of again, opportunities to make money in certain investment environments. And so long as you're starting from a good standpoint of, or at least where you think is things stand at a particular time, then, opportunities are out there.
It's interesting we talked about Bitcoin earlier because when you talk about Bitcoin, I think Bitcoin is not really an inflationary trade. I think fundamentally it's a disinflationary trade, but people are treating it like it's an inflationary trade. And that could do weird things to price. So the Bitcoin price could go up to 100,000 because there's a mania. It could still go down to 10,000 again. People forget that.
It already did once, right? In 2017, we had sort of a Bitcoin mania that crashed in 2018. When just as you said, Josh, when everybody was piling into Bitcoin for reasons they probably really didn't understand, and then all of a sudden those ideas started to crash along with the ICO boom and everything else, every other ridiculous thing that went along with it. Suddenly, Bitcoin was the last thing anybody wanted to buy in 2018, and I don't think many people understood why that was. They piled in and they piled out, and nobody really made much sense to it. So now they're doing the same thing. Again, I think there's a difference. You have to separate out, what people may be doing, sort of this digital or crypto mania that's going on in the public, sort of the retail investor. Separate that from the development and the technology and infrastructure behind the digital currencies themselves, at least the ones that are taking themselves seriously. And you're right, it is a disinflationary. The technological trend is because of the disinflationary stuff. But I think, the public, the retail public that's piling into these, they're doing it because they think they need to hide from inflation or the dollar's going to crash or whatever thesis that they hear on the morning news.
Which is interesting. So you're, not that you're making a case for Bitcoin, but the long-term case is really as a trustless system of account rather than a hedge against inflation. Would that be fair?
Yeah, if we separate the monetary functions, there's three monetary functions. There's unit of account, there's medium of exchange, and store of value. I think what you just said was absolutely right. Most people are looking at Bitcoin as a store of value when its real use, I think its real long run potential use, is as an actual medium of exchange. And I'm not speaking just about Bitcoin. I'm talking about some of the more serious digital currencies like Ethereum and some of the other ones that are actually looking to be a medium of exchange, even though the people that are bidding up their prices are looking at them as a store of value. And that's really, I think that's where the disconnect comes from, is where there's we get into the .com type situation where it looks like a bubble because people really don't understand the true nature nor the potential of what are really disruptive technologies. And that's where we are. The technology is still being disruptive. It's hard to sort out the winners and losers, which in this kind of market and climate just means people fear missing out. They want to pick the winner today, even though the winner might not be apparent for 20 years. And that leads to all sorts of let's call it volatility.
You know what I just thought about when you said there? I thought about Microsoft. You know, Microsoft really transformed the world in the 90s.
Absolutely.
And then their stock went, and then all of a sudden it crashed and did nothing for 10 years. We could see that with cryptocurrencies. And you have this mania, and then people lose so much. I remember the guy who originally turned me on to Bitcoin. He got in like early. The guy would be worth about $100 million extra. But he got so discouraged when it went from 20 grand to like 3. He sold all of his Bitcoin and would be worth a significant amount today. I thought, Microsoft or Amazon, meaning when you have disruptive technologies and people don't understand exponential technologies with investing, you do have this mania and then this washout period, kind of a U-bottom.
Yeah, it's like a winter.
That could last for a decade. People forget that.
Yep.
It's like I was looking at the chart on AT&T. It was like 5 years of a winter. You know, stocks do that, and then all of a sudden, like, it starts coming up again. And I remember one of the best stocks. I remember telling people in 2010, talk about opportunities. So I was younger. I was telling people, Microsoft's a really good value. And my clients looked at me like I was a loser. Yeah. And if I brought it up again, they might want to fire
that dog,
me.
Right?
and you did mention that stocks are no longer kind of they're no longer tied to their fundamentals. It was very interesting. In 2009, they were for a change. In 2010, and that was a great time to be an investor. Fortunes could have been made just buying, value stocks from 08, 09, 010. That's an interesting question. Value has lagged for a while now. Could that be an opportunity now, value stocks, since it's done so poorly the last decade?
It really depends on the stock market secular trends, which have favored growth stocks for various reasons, largely because, again, I think the stock market in general is divorced from any kind of fundamentals, which means that you're only valuing the future, which you can always see the future any way you want to. That's why the appeal of forward earnings, which is a way to fool ourselves and to rationalize stock prices as sky high because, this company will obviously do well in the future, regardless of how it's doing in the current day. So as long as that's allowed to happen, allowed is not the right word, but as long as that continues to happen, I think you'll see growth stocks be favored because it's always about what does the future look like, and the future always looks like whatever you want it to be. But I think you made a really good point about digital currencies that, I think that's probably the case where we go through a digital currency winter while the disruptive technology kind of settles out all of the various needs that it needs to go, all the various evolutions and transformations and steps that it needs to go through to become an actually useful technology. It's not there yet, which is, that's part of the excitement is which one is going to win, like the dot-com era. I think those are two perfect analogies, or at least one analogy that's perfect for what's going on now because, again, the internet was a disruptive technology. And if you remember back in the late 90s, you had no idea what these companies were doing. We had no idea what they were doing. You just wanted to own those stocks because everybody else did, even though you couldn't really sort out the winners from the losers. Although Microsoft really should have been one that you said, that they're probably likely going to win. But disruptive technologies take a lot of time to settle and mature.
But so few people took that trade. That's so funny. Right on. So we'll take our next break. We're going to finish this segment. Then we'll be back with the final segment with Jeff Snider, head of global research at Alhambra Investments. And folks, call us 888-988-JOSH, 888-988-JOSH. Jeff, have you written any books? I'm like, I'll give his book away. But
no, I can't see spending 6 or 8 months for something nobody would ever read.
Oh, I think it'd be a bestseller. So you're a bright mind. So 888-988-JOSH, 888-988-5674. And you get to score your top 5 investments from a perspective of fees, risk, and taxation. And you get 45 minutes with me, Josh Jelinski, the financial quarterback. 888-988-JOSH, 888-988-JOSH, 888-988-JOSH. And we're back. Jeff Snider, I have a whole slew of questions, which were my talking points that I didn't really get to because I was so fascinated with what you were saying. So I want to run down a couple of them if we have time. You've said that conditions in the euro-dollar system have far greater impacts on the global economy than efforts of central banks, and that this shadowy system dwarfs the Fed's role. You've elaborated on it a little bit, but I like the way that question was phrased. Can you elaborate on that just a tad more?
Well, like I said, the Federal Reserve isn't actually a central bank. It doesn't actually do money. Therefore, its role is to try to manipulate sentiment, which it has a tremendous amount of success in the stock market when everybody says, oh, the Federal Reserve is doing something, we want to buy stocks because there's no risk. But it has no or very little use in the real economy. So that's why you have this disparity between what stocks are doing and what the economy is doing, because the economy, as it has since 2007, August 9th of 2007 exactly, the economy is suffering this real money withdrawal, this real money breakdown, this disinflationary environment, because that offshore Eurodollar system actually needs some kind of function. It needs some kind of fixing. It needs some kind of attention that the Federal Reserve can't give it. And because it is the global reserve currency, any negative impacts from the Eurodollar system are going to impact negatively all the parts of the global economy. It's not just the United States where you see growth has gone off track right in 2008. You see it in Europe. You see it in Asia. You see it in emerging markets where growth, it's like the global economy forgot how to grow. But it didn't forget. It just doesn't have the money to grow because the Federal Reserve is not a central bank. It doesn't take care of the dollar.
So what
system.
about people would say,
system.
What about Volcker? So his power was meaningless when he jacked interest rates up and destroyed the country for a few years? Or somebody could say he saved it or whatever, the theory is.
That's the myth. The myth is Paul Volcker saved the world from the great inflation, and in doing so, he created this expectations management policy, which basically said that, look, don't ever fight the Fed because look at what Volcker did. He provoked two of the worst recessions in history, and he did one after another. So don't you dare fight the Fed, or the Fed will do that. But that's not really what actually happened. And I want to, address something you said before, Josh, which this sounds like a conspiracy theory. What I tell people is you don't need to take my word for it. Just do a little bit of research. And when you do a little bit of research, you will see that these central banks admit they don't do money. They do expectations manipulation. I'll give you a couple good examples. Alan Greenspan, throughout the late 1990s, during the dot-com bubble, his famous irrational exuberance speech from December of 1996, where he said those words, everybody thought he was talking about stocks. That's not what he was talking about. If you read the actual speech, what he said was, money supply trends had veered off path years ago, and so we have no idea of knowing if the stock market is being irrational or not, because we have no idea what's going on in the monetary system. A couple years later, in a private FOMC conversation, Alan Greenspan said, we don't do money. We can't even keep track of it. We have no idea. The proliferation of products, that's the term he used. The proliferation of products has been so extraordinary, we cannot base monetary policy on money. Therefore, it's not really monetary policy. It's something else entirely. And as you just pointed out, Josh, it goes back to the Volcker myth, which is the idea that the Federal Reserve provoked these recessions, and therefore it was a show of force. So never question the Fed, never think about what they do too hard. Just accept that they know what they're doing and they're all powerful and everything will be fine. And that was just never the case. And that's really how you got a global financial crisis in 2008. How can this all-powerful Fed that it does everything, the Greenspan put, all this stuff, how could that happen? How could 2008 happen if the Fed is all-powerful? And the answer is because it's not. It's all an illusion. And again, you don't have to take my word for it. All you got to do is a little bit of digging, and you'll see that they actually admit that monetary policy doesn't have money in it. It's something else entirely.
So what do you make of March 2020 where I don't know exactly what they did, which kind of gets to the point. There was a purchase of $400 billion of corporate bond ETFs, which I thought was really unprecedented. I mean, I guess it was precedented with 08, 09 with the bonds and the bailouts of banks, but literally buying corporate bond ETFs. What happened there?
Yeah, and there wasn't really that much. It was they bought a few bonds,
and then it was paid back.
Implement this expectations policy because they were looking to make it seem like they were supporting. Again, like I said before, the Fed is not a lender of last resort. They're not a central bank. They're trying this market of last resort crap, which is exactly what they said. They try to buy securities in order to buoy market prices in the hopes that would actually fix whatever crisis is happening. That's not what central banks are supposed to do. So central banks are supposed to do
whatever they did,
elasticity, especially in crisis.
But whatever they did with the $400 billion purchase of the corporate bond ETFs, some could say it worked because it averted a depression.
That's what they really love, right? That you can never prove that it worked or it didn't work, right?
Well, here's where I would challenge you. I agree.
Without QE, it would have been worse, and you can never. That's a counterfactual that you can never falsify. How do we know that the Fed actually fixed the system last year? If you actually know what happened in March 2020, you would shake your head that the Fed performed absolutely horribly. The very fact that we had that crisis to begin with shows that the Fed is ineffective at monetary policy. Again, they admit that. That's why they do this market last resort stuff. If you remember anything about March 2020, the Fed did one thing after another, and we had this 3-week period where no matter what the Fed did, it didn't stop the crisis because the crisis was, again, a global dollar shortage in the Eurodollar system that doesn't have a place for the Fed in it. And it touched on repo, it touched on collateral shortage and scarcity, all of these things that Federal Reserve's monetary policy has no ability to influence, let alone, fix the problem.
But was
so
there
the Fed
not
wants you to think counterfactual that it did something?
I agree with you, but on the one point, there was some liquidity crisis in the bond market in March of 2020. And this, by the way, is a very real problem. I want your take on this. I talked about this like 10 years ago. The flood of money into index funds will create enormous problems in the market. I think March 2020 was like the first window of the next global economic collapse. And I've been talking about this for years. People said, oh, ETFs are good. I had a listener who said, oh, I was a part of it. What you're talking about isn't true. And all these people were selling LQD. They were selling the corporate bond ETFs, whatever symbol they are. I'm not saying buy or sell anything. They were selling all these various bond ETFs indiscriminately because they were selling stocks, they were selling bonds. They wanted dollars.
Yes, liquidity crisis that the Fed doesn't fix.
So but they were buying the bonds, the $400 billion that they lent.
There wasn't $400 billion. It was only a couple billion. To number one, and number two is that didn't really have a major impact. It did on sentiment, but even corporate bond prices didn't really come back up all that quickly even afterward. What actually happened in the bond market, when it had to do with junk bonds and corporate debt and euro bonds too, was that it had to do with collateral and repo and things like that, and that risky assets in the repo market, though, that's like poison. It's the same kind of thing that happened in the 2008 crisis with subprime mortgages as repo collateral. The system is not set up to allow an adjustment of haircuts and adjustment of valuations in repo because that herds everybody into the safest, most liquid forms of collateral, which is what you saw in March of 2020 as well as in 2008 crisis. And part of the other problem is the Fed kind of came in late with buying treasuries because the treasury market seemed to malfunction too, but that wasn't really the case either. What you had was this global dollar shortage in the marketplace, as you just said, Josh, where everybody wanted dollars because funding had dried up, liquidity had dried up. And what that did is it caused reserve managers outside the United States to sell a lot of their U.S. Treasury holdings, but they only sold the illiquid off-the-run treasuries, and they tried to pawn them off on primary dealers. Now, primary dealers, when they get an off-the-run treasury, try to repo it in the repo market to fund that transaction. But the repo market was part of that dollar shortage, which meant that the repo market wasn't working either. So you had this pile of illiquid treasuries that couldn't trade anywhere. They created this knock-on cascading effect, and that's really what happened in March 2020 behind the lack of liquidity, where the Fed didn't.
No, I agree with that. But what happened with the bond ETFs? What happened with the index funds?
They were selling because those prices started going down because of the dollar shortage issue. And as soon as junk bond and any risky prices started to fall, everybody, the herd instinct is everybody gets out of those things. And you're right, Josh, that did exacerbate the decline because you remember I'm sure you remember really well, credit spreads spiked enormously. And that was because of the lack of liquidity, the lack of dollar funding in the global marketplace, in the Eurodollar system, that the Fed didn't do anything to help out with. That was simply a global crisis that had all of these knock-on liquidity effects, including tanking the previously invulnerable stock market. The stock market fell by, 35%, the S&P 500 declined, which is the only substantial decline of the last, decade. That's how bad liquidity got, and that's how bad the Federal Reserve functioned in reality.
Well, this was fascinating interview with Jeff Snider of Alhambra Investments. Alhambra, if you want to Google it, is spelled ALHAM BRA Partners. AlhambraPartners.com's Jeff Snider. Thank you, Jeff. And anything you'd like to plug for our listeners or viewers?
Yeah, I do a podcast, too, with my co-host, Emil Kalinowski. It's called Eurodollar University, where we talk about all this monetary stuff, being collateral and treasuries, and the Fed being a lender of last resort or not a lender of last resort, and what that means. It's called Eurodollar University's Making Sense. You can find it on YouTube. You can find it on the podcast outlets everywhere.
Fascinating. Thanks for joining us. And folks, give us a call, 888-988-JOSH, 888-988-JOSH for the free 45-minute ultimate financial game plan. And you get to score your investments from a perspective of taxes, risks, and fees. 888-988-JOSH, 888-988-JOSH.
The preceding program was sponsored by the Jelensky Advisory Group. Any awards, rankings, or recognition by unaffiliated third parties or publications, including 5-Star Wealth Manager, Advisory of the Year finalist by Senior Market Advisor, and Top of the $1 Million Roundtable, are in no way indicative of the advisor's future performance or any individual client's investment success. No award, ranking, or recognition should be construed as a current or past endorsement of Josh Jelensky or Wealth Quarterback LLC. Information regarding specific awards, rankings, or recognitions is available on the Wealth Quarterback website at www.jelensky.org. All investment strategies have the potential for profit or loss. Investment strategies such as asset allocation, diversification, or rebalancing do not assure or guarantee better performance and cannot eliminate the risk of investment losses. There are no guarantees that a portfolio employing these or any other strategy will outperform a portfolio that does not engage in such strategies. This broadcast should not be construed by any client or prospective client as a solicitation to effect or attempt to effect transactions in securities or the rendering of personalized investment advice. Due to various factors, including changing market conditions, the information discussed in this broadcast may no longer be reflective of current positions or recommendations. While information presented is believed to be factual and up to date, Josh Jelensky and Wealth Quarterback do not guarantee its accuracy, and it should not be regarded as a complete analysis of the subjects discussed. The tax and estate planning information discussed is general in nature, is provided for informational purposes only, and should not be construed as legal or tax advice. Listeners should consult an attorney or tax professional regarding their specific legal or tax situation. Advisory services offered through Wealth Quarterback LLC.